Guys, well, it's time to get this started. I'm Ricky Analog from TrueTrader.net. This is the Sunday Prep. Before we get started, real quick, if you guys don't have a broker you can trust, check out Cobra. There's a link in the description. It'll get you 25% off your commissions, and it will get you 1 month free of whatever platform you choose. SBUX, you guys, if you don't know about them, you better learn about them. These guys have a platform that allows you to pull historical stock data. So if you think that you notice some sort of pattern or edge in the market, you need to actually quantify that and know that you have a defined setup with statistics backing it up, right? These guys make a product that shortcuts it all, so you don't need to do it manually, which I used to do for years, and trust me, doing it manually is no fun. So there's a link in the description for them as well. Scripts to Trade, these guys make code tools for Thinkorswim and TradingView, and they have a whole suite of pre-made indicators and tools that you can go and choose from. You know, you used to be able to just buy an indicator. I believe they are now, because they have such a high demand, they're switching to a subscription monthly based plan. I don't know the full details on it, but check them out. They do have actually a free indicator if you want to grab the VWAP Boulevard indicator. That is free from them. And anything they don't have, you can hit them up and they will custom make any kind of code or tool you can think of for your platform. TraderView, this is the company I use to track my performance metrics. If you guys aren't doing that, you're doing a huge disservice to yourself. There's more than knowing just the statistics of your setups. You need to know how you're performing and where you're coming up short, and where, you need to know your strengths and weaknesses. It's hard to do that if you're not tracking stuff. Check them out, guys. There's a link in the description for them. Traders for a Cause is coming up at the end of September, the first week of October. Obviously, I got my Traders for a Cause shirt on, trying to represent, guys. I'll be out there. I think I'm speaking on a panel this year. It's always for a great cause. If you aren't going to be able to make it, go to projectimpact.org, I believe, and you can make a donation to them, and you sign up for that, and you will have access to the live stream version of Traders for a Cause event in Vegas. Now, if you do that, you're entered into a drawing to actually win an all expense paid trip to Vegas. They'll put you up in the hotel. They'll pay for your admission to the event. They'll take you to the VIP party. You'll be privy to everything. The only thing you would have to do is pay for your airfare. So if you can't make it this year because you couldn't afford the hotel and the ticket or whatever, you can go make a donation to a good charity, right? A cancer research charity. You'll be able to watch the event, and you have the chance of getting a free ticket out there, guys. So check them out. There is a few earnings on the docket this week. Stitch Fix is one. I have a small position in them when their I don't know if it's their CEO or chairman, somebody on their board took a gigantic position on them. So I'm actually really kind of interested to see what they do with their numbers this quarter. But I am kind of watching them. The only other one I really care too much for in this is there's FedEx and Costco. FedEx already kind of shat the bed last week on their pre-earnings announcement about coming up short on, I think, what their forecast was, right? So we are at the tail end of this earnings season. It is what it is, and things will pick back up when we get back to next quarter's earnings, which, trust me, you blink and they're here. It just happens that way. Time doesn't slow down, and I mean, that's why I'm so adamant every single week about pulling away from the screens and realizing there's more to life than just the markets, right? So because before you know it, your kids will be going to college. You'll wonder what the hell happened, and you'll be regretful that you spent so much time with blinders on, right? So let's just get into the topic this week, which, if you guys saw the title, right, it's the correct way to anticipate the end of a bear market. Now, I'm going to use a lot of the broader market discussion in this topic. So what I'm going to do is I'm going to go ahead first and do the disclaimer, and then we can get right into everything, right? So real fast, guys, neither TrueTrader, me, or any of our representatives are registered as security broker dealers. I'm not a licensed financial advisor. Anything you hear me talk about is just my opinion. It's not a solicitation to buy or sell any stocks. This is for entertainment purposes only, guys. All right, so the reason I wanted to talk about this topic is, well, one, I think it's going to be in play soon, right? But two, ever since the market turned from being bull market to a clear and objective downtrend, a bear market that we're in, the question every single week in every space call I go to on Twitter, on every YouTube video I see on YouTube, on every Instagram reel I watch, is like, when will it end? Where is the bottom? And this whole need for some form of certainty to predict, right? Everybody wants to be able to predict what's going to happen, and I try to kind of touch on this every single week, right? Which is that you don't need to predict anything, right? We just need to stay objective, read the trend, and create if-then statements, and be at peace with knowing that we're probably going to be wrong, but when we're right, we know when, and when we're wrong, we know when, right? So it's just as simple as be able to create a game plan and have discipline to adhere to it. Now, let's actually go. I'm just going to get straight into some charts because, like I said, we're going to use the topic that I'm talking about the correct way to anticipate the bottom of a bear market and when we may turn. And so I'm going to be talking about, we'll just use the ES for most of this discussion, right? So here's your ES chart, right? And this is a daily chart. Let me actually move some things around on my screen for a second, guys. I'm sorry. Just need to make it so I can see better. Okay, so we're looking at ES, right? You had a clear, very, very long, very, I can keep zooming out. This is COVID right here, right? I wouldn't really call that. It's not the same as an extended bear market, right? And you had 2018 and 15, which had, much more shallow pullbacks, right? Corrections. But you could make an argument that we've been in this bull market, right, since the great financial crisis ended, right? Like a 13-year bull market, right? 11, 12, 13-year bull market. And we've talked about this, right? We've talked about the fact that when we were in that bull market, there was perma bears that were trying to call the top the whole way up. And now that we're in this downtrend, there's perma bulls that are trying to call the bottom the whole way down. So you do have this environment where you constantly have people trying to pick bottoms. And as long as we know what needs to happen on different time frames for a downtrend to end and for a new uptrend to resume, then there is no need to get in the habit of trying to catch a falling knife, right? So like if I change this to a weekly chart and you start looking at these big drops, right? Let's just say from March to May, when we were just constantly down, there's people probably just trying to average into this thing the whole way down. And I don't like to say that something is right or wrong, but in the way I trade, there's no way I would want to be just buying this, hoping that the bounce is coming, because we've seen times where things can go way further than we ever anticipate. And that's not the position to put yourself in. You need to understand that it's okay to just be patient and hands off and let things kind of unfold and develop. You don't have to just be adding as is going against you and hoping and praying. Instead, you need to understand what you're seeing on one time frame can actually be something developing on a whole different time frame, right? So what I did for this week's Sunday prep is I basically have laid out the different scenarios that I think, actually, I mean, this is really kind of objective, so it's not really what I think. It's just there's only a few different scenarios that can play out from here, right? So I've laid them out, and I'm going to talk about each one of them and how I would create if-then statements based off them, okay? So if we're in a downtrend, which we are, and the weekly time frame is in control, which it is, and you'll notice why I say that, right? We flush out, we're lower highs, lower lows. We finally get a reversal, and what's it do? It pushes back into the weekly 20 and it rejects. And then we come back, we get the lower high, lower low, and then, which is a short continuation trigger, and we head lower. The short continuation trigger does what it was intended to do. It takes you to the target and then takes you to new lows, and a trend continues. So we continue lower. And what happens? We pull away from the weekly 20, we trend lower, and then we finally have another reversal signal, right? And what does it do? It takes us to the weekly 20 and it rejects again. Now, we've talked about this in a few of the Sunday preps where people get it kind of confused because we have pushed through the weekly 20, but it doesn't matter in my opinion. This is still the first pullback into it. And so what happens next is what matters. And what happens? Well, we get this pullback here, the push down, the lower high, and then we break, right? So we in turn literally just had the exact same short continuation trigger that we had back here. And so this one's a little harder to see. I'm actually going to get rid of this circle here. We're going to put some new circles on here this week. So I just want to illustrate this one here so that you can see that it actually did exist. This right here, the high of this week broke the high of the previous week. This was that lower high. And then by taking out these lows here, that was that same short continuation trigger. So now we're seeing that exact same thing set up here. And it triggered on Friday, okay? So here you go. You get your pullback into the weekly 20. We probe lower. We try to get rallying again, and we put in a lower high, and then we break these lows. So this trigger, by definition, the defined target is these lows, and the trend can continue lower. So there's only two broader scenarios that are going to come of this, right? And if you're trying to understand, actually, wait, let me not get ahead of myself, guys. Let's look at a monthly chart real fast. So on the monthly time frame, what we are seeing is the possibility of having this lower high here, and then the break at these June lows, right? I'm going to probably refer to these throughout the Sunday prep this week as the June lows because that's really what they were, right? So if this monthly time frame is going to go lower, it has to do so via lower highs and lower lows, correct? Stick with me, guys. So what we've had happen, we had one lower high. This was in March, right? The bear market, obviously it's in hindsight. Nobody knows exactly when it's starting. There are clues, there are things in trends that change on lower time frames. And we can look back and say, look, on the monthly time frame, that was definitely the beginning of this correction, right? It was in January. So in January, we had that correction, and it was in March when we tried to push higher, and we ended up making a lower high. And what happened was we rolled lower, right? That's how things trend lower. Lower high, lower low. Stick with me. And that's exactly what we're seeing start to form here. August put in another lower high. Now, this, in hindsight, will not be a lower high if, well, let me find the right tool here. Where's my brush? Right here. If we never break June's lows, right? If we never break June's lows, this won't be a lower high. Instead, what we're going to have is the possibility of a higher low here, okay? If we somehow make a higher low by not breaking June's lows and then take out August's highs, that is how trends reverse. We talked, I believe it was last Sunday prep or maybe the one before, we talked about this exact setup. So this shouldn't seem new to you guys. You should be like, yeah, I remember that, okay? So what I want to point out here is there is a time and a place where anticipating a reversal in a trend is it's not that bad, right? So there's always going to be this trade-off between risk reward and win rate, okay? And so if this is going to make, let's go back to the weekly chart. I wonder if those squiggles, yeah, the squiggles are still there. If this is going to make a higher low here, right? And then reverse, it's going to do so on the very lowest of time frames and domino effect its way up through the time frames. Let me explain this a little bit. So let's look at a daily chart. So as we're trending lower, right? As this move comes down, 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 we don't know where it's going to reverse, right? But if we have a thesis that we're going to make a higher low instead of taking out June's lows, if we have that thesis, then what we're looking for is the lower time frames to reverse first, okay? So I would actually make the argument that I would probably be watching time frames such as the 20-minute and the 120-minute Because if they get really extended, let's say on the daily chart, this starts puking. I need to get rid of some of these squiggles that I drew. They're kind of really messing everything up here. And let's look at without the pivots. Okay, so if this really starts to speed up downwards, right? As it comes down, we're getting extended from the 20-day. Things, even if it is going to go lower, if we're going to break June's lows, we're not going to do it just straight down. It's not just going to puke out and fall forever. It's going to do so by making lower highs and lower lows, even on the intraday time frames, right? But if it speeds up, if this really speeds up down here, we get really far away from the 20-day, you're going to look on intraday time frames, such as even something like an hourly, right? And what you'll notice is even on the hourly chart, we're falling so fast that we're pulling away from the hourly 20. And maybe the 20-minute chart, we're pulling away from the 20-minute 20. And you will not get a reversal on the daily chart or the weekly chart until those lower intraday time frames first reverse, and they will domino effect up through the time frame. So what you would first see is the 20-minute chart. It's just peeling down, peeling down, peeling down. What you'll see is it, and I guess I can just look at a 20-minute chart and try to show you guys. But if this thing just starts falling apart, coming way down, eventually what you're going to see is this thing put in a low and then a higher low, and then it's going to start to reverse, right? And it's going to be a magnet back to the 20-minute 20. And what you're going to be looking for is you're going to say, look, if I'm trying to anticipate a higher low on the weekly chart, right? Remember, we are looking for a possible reversal to end a bear market, right? If this is going to put in a higher low, there are ways to look for that reversal on the lower time frames first. Now, why would you want to anticipate? Why should we anticipate this move? Well, for one, even for day trades, like I said, when we speed up to the downside, there's going to be reversal plays, even if they're just day trades, right? Things don't just flush out forever. The big emotional flushes give us huge opportunities to take reversal trades for day trades. But if you're thinking big picture and you're looking around at the market and saying, look, there's a time and a place where anticipation plays a smart role, it's these opportunities here where, let me see if I can get rid of these white lines I drew. Sorry, guys. It's the ability to look at this monthly chart and say, look, maybe I'm going to be wrong. And here's the thing. Remember, I told you there is a trade-off between risk reward and win rate. I'm okay sometimes with being wrong and knowing that I'm putting on the trade with a very high probability of being wrong, but also knowing that the risk reward is so asymmetric that I don't care, that it's worth it. It's worth the risk. And so like I argue that when we're making this move down here in June, when we didn't know where the lows were, right? We had nothing to risk off of. At that point, it's stupid to be anticipating because there's no defined risk. But at this point in time, if we come down lower, like just looking at the ES right now, right? If the ES comes down into 3,800, 3,750, we're down here flirting around and we're extended from the daily 20 and we're extended from the 120-minute 20 and the 60-minute 20, and we've just been puking out. If you were to look around and have a game plan for stocks that you would like to add to long-term swing long positions, like the people that always want to know when the bottom of a bear market is, you know who they are, right? They're the guys that are in all cash in their IRAs and their 401ks and their freaking long-term portfolios, and they're just wondering like when can they step back in, right? It's not that day traders, we don't care. I don't care if it's a bear market, flat market, bull market, whatever, right? Because I'm going to make my money on intraday moves. But the guys that are on the sidelines in all cash that want to know when a bear market's going to end, there's nobody with a crystal ball that can tell you that. But I can tell you how to create an if-then statement where the trade is asymmetric. And so what I wanted to show you guys was the difference here of anticipation versus confirmation. So, and that was another thing I wanted to point out too, right? If you are not comfortable with being wrong very often and taking your stop losses, then it may be smarter for you, might suit your personality better to be the type of person that waits for the confirmation, right? And what that would look like is we don't know where a higher low might form, right? Maybe it's down here, maybe it's here, maybe last week put in the lows. We don't know. But if we do not break June's lows and then we go and break above August's highs, that is the confirmation. At that point, the monthly time frame has pulled back to the monthly 20, put in a low, put in a higher low, and then is trying to reverse. And that would be the first step to having confirmation that the bear market may be over. Now, you always have to keep in mind that even on these super high time frames, we talked about this the other week too, right? It doesn't happen very often. I only found, I think, maybe one or two other occurrences on SPX where in the past it had happened. I think one was 1969, was where you get this reversal and then we fail to reach all-time highs, which is the target, okay? And you put in a lower high here versus these all-time highs, and then we lose the lows, and that's where things can get ugly, right? But at least your risk is defined, right? If you wait till the break of August's highs to start buying dips and kind of dipping your toes in the water, then so be it. That's your comfort zone. You need to feel like you have a higher probability of being right, and you're okay sacrificing some of that risk reward for that. But I want to illustrate the difference in that risk reward. If I'm willing to start buying dips down in the 37.50 area, now granted, keep in mind, guys, I'm not getting long ES or the SPY. I'm using this as an indicator for the trend of the overall market. Hopefully everybody understands that. So what I'm doing is creating a watch list of names that I would go to, that I would like to buy when the bear market is over and put in my long-term portfolio. Okay, so stick with me on that part too. But if I'm willing to start looking at those names seriously, when we come down into the 37.50 area on the ES, look at the risk reward. So you're wrong if we lose June's lows, right? And if we're buying equities that have similar setups and we're anticipating that it's going to make a higher low, let's say somewhere in this 3,700 area, okay? The target is up here at all-time highs. So you're looking at 6 to 1, 7 to 1, something like that. You can be wrong so often, right? So often. And when this works, if you do scoop some positions, and here's the other part. If you put positions on down here where you know that you have a higher probability of being wrong, but it's very asymmetric, you don't have to put on full risk. You could put on a half position, a quarter position. And as it starts working, you can build in, right? Maybe when we break over August's highs, if we were to break over August's highs, now you have confirmation. Maybe that's the point where you start to build into full size positions, right? But this is 6.5, 7 to 1 versus if you wait for confirmation up here over August's highs, not even 1 to 1. Now, granted, if I was the guy that's waiting for confirmation, if I'm waiting for a break over August's highs before I start in, I'm probably not buying it as soon as we break August's highs. I'm probably waiting for dips, right? Somewhere where I can get at least 1 to 1, maybe a little better. I'm hoping for 2 to 1, something like that. But you got to wait for better prices, in my opinion. Because even though you have a higher probability of being right, you're sticking your neck out on the line having such a piss poor risk reward for the trade idea, right? We as traders get paid for taking on risk, right? The riskier something is, the higher the payoff usually is, because you're the one that has to stick your neck out to take that risk. So if we were going to anticipate, you want to do so when we've already put in and established some lows and things are shaping up on all the time frames. So let's look at the time frames, right? Weekly chart, downtrend, right? Weekly chart, downtrend. Daily chart, downtrend. If we start seeing downtrends on all these things, except the monthly chart, right? The monthly chart you can look at this and objectively say, really, this is the first pullback into the monthly 20 since the COVID era, the COVID dip, right? When we had COVID, we made a big pullback into the monthly 20. Same with late 2018, early 2019, right? Pullback into the monthly 20. Now they pulled back through it, but that's not the point. That was just the reset. So we've had a reset. And how do these things end? Well, they end when we stop making lower highs and lower lows. And that happens on these higher time frames. So we've had the big pullback. We had the push up. And now we're pulling back again. And we have the ability to responsibly, that's the key word, responsibly anticipate a higher low, which gives you great risk reward, knowing you're most likely going to be wrong. And, keep in mind, guys, the weekly chart, and I need to get rid of this circle there. The weekly chart literally just triggered a short continuation, right? This is the author of the weekly time frame telling you, hey, I'm trying to get back to the lows, okay? So the defined target is the lows. The setup has occurred. We have good reason to think that's where we're going, right? But if it fails to get to those lows, those failed short triggers create the powerful long triggers on the higher time frames. So that's why I'm trying, and listen, there's a time and a place to anticipate, and the time and place is when the context gives you that green light, right? The context here, granted, I know that I think the probabilities are low, we end up making a higher low on the weekly chart or on the monthly chart. Another thing I always focus on, I want you guys to keep this as a tool in your belt, is every time you have an idea, what can you say to poke holes in it? How can you make your idea sound stupid? Well, when I look at this, the first thing that makes me feel stupid about this idea is that this is just a push into the underside of the monthly 20 that's really very convincingly rejected, right? And we can go back in history on the monthly chart on the ES and see the same thing. Look, this is 2008, 2009 great financial crisis, right? GFC. Pullback below the monthly 20, shove into the underside of it and stuff convincingly. Kind of reminds you of what we just did, right? And look what happened to that, okay? Now listen, I would make the argument that you could have been doing exactly what I'm talking about right now on this monthly candle right here. June 2008, you could have been anticipating a higher low here to get us out of this correction. And guess what? It's imperative that you stop out when you're wrong, because that is what can happen. Do you guys understand? Like that's the importance of anticipating responsibly. You can't anticipate on this candle on January 08. You can't. What are you risking against? There's nothing there. But after we make this push up into the underside of that monthly 20 and we're pulling back down, now we have defined risk if we want to anticipate, right? Do you guys see that difference? There's a huge difference. And we can do the same thing with 2000, 2001. Look, underneath the monthly 20, shove into the underside and stuff convincingly and roll back over. Now, are we doing that same thing? Are we going to go into a recession? Because think about it. 2000, 2001, that was the dot-com bubble. Great financial crisis, big recession. The more shallow pullbacks weren't really crazy recessions. And in fact, I'll show you some charts later when we get into the sector analysis where we kind of can look at comparatively what the federal funds rate was during different times, right? But even though I can poke holes in my thesis, the risk reward and some of the sectors that I'm looking at are giving me the desire to anticipate a higher low here, and just making sure that my risk is completely controlled, right? It doesn't matter if you guys want to risk, everybody's account is different, right? And everybody's risk tolerance is different. But whether you want to risk $100, $1,000, $10,000, or you want to risk, maybe you trade millions of dollars and you're willing to put 50K, 100K of risk on to see if you can be right in order to make a magnitude in return, It doesn't matter because your risk is defined, right? So I can put a trade on, I can tell you my position size based on where my stop goes and just say, look, it's not up to me if this trade works or not. My job is to identify the high risk reward setups, the asymmetric setups, when there's a defined risk where I feel safe taking it, put the trade on and let the author do what the author does, guys. And that's as simple as I can make it. Now, the other scenario, so that was the scenario I was trying to illustrate there was that the lows are in. June's lows are the lows, and this will make a higher low, and we have defined risk, and we can put ideas together with if-then statements. There is another scenario, which is that the lows are not in. Okay? These are, let's say June's lows are not the lows, and the weekly short continuation trigger that we just had will do its job and take us to new lows, and the trend will continue. If that's the scenario, remember, this is if then, right? First of all, for day trades, nothing changes. Continue doing what we've been doing, what's been working, which is shorting pops back into clearly defined levels of resistance. And not, listen, making sure that we understand on the daily time frame, if things get extended to the downside. Remember when I don't remember how many weeks ago this was for Sunday preps, right? 2 or 3 Sunday preps ago, when we were having this big move down, we were saying, look, I don't care if you think the market's going lower, it's going to have a higher probability of a bounce soon and have that face ripper, because it's going to get, it can't just go straight down. So as we had this big move down, look what we got was that face ripping rally right back into the 20-day, making the lower high on the weekly chart, setting us up for that trigger, and then firing off. But since it's happened, what have we done? Straight down, right? So if this continues straight down, and you think that the scenario is that the lows are not in, and that we're going lower, there's a recession looming, whatever it be, you don't want to short in the hole. You still want to be smart about picking your spots, because what you're going to end up doing is shorting and covering when it has that face ripper day. You're going to cover on the day you should have been putting the short on, right? Those face ripping rallies into resistance are giving you good opportunities to put on short positions, but you can't already be short when it happens, or you're going to be the guy that becomes the liquidity for the other shorts. So make sure you understand, as long as we're trading above June's lows, we got to wait for pops to short. If we break June's lows and the trend continues lower, at that point, I feel like you can begin to get more aggressive with where you take your shots on shorts, right? At that point, you now have the monthly chart in also telling you, look, lower high, lower low, and this thing could really start to unravel, right? At that point, anybody that was anticipating a higher low is stopping out, or at least they should be. And you can start to say, look, all trends now point down, right? This is going a lot further to the downside than just a slight correction back into the monthly 20. And so those are the scenarios, right? So remember, the two main scenarios where we create our if-then statements. The first one is that the lows are in. June's lows are the lows, and this pullback here is going to make a higher low, and we can anticipate with really great asymmetry in these setups. The other scenario is that the lows are not in. Last week's trigger that triggered on the weekly time frame is going to take us to the defined target and then lower, meaning the trend will continue and the bear market will stay a bear market, right? And what happens then for the people that are asking, where's the bottom? We go back to stalking, right? Just like we've been doing, just like we've been waiting for, knowing that things have to reverse on lower time frames first before they can domino effect up through the other time frames. That is what is important. That's how you read charts objectively. That's how you stay safe. And that's been my main goal since this whole, even when we were still in the bull market and we were doing these Sunday preps. My goal has always been to keep you guys safe by teaching you how to just know how to create the if-then statements, know how to define risk, know where to pick your spots. And that's really the goal, right? I love being able to give you guys ideas, like trade ideas. And yeah, it's great when they work. It's freaking funny as hell to me when they don't work and people are like, hey, Ricky, nice call, you dummy. Yeah, guess what? I take losses, guys, but it doesn't matter. It's part of the game. I'm not embarrassed by the fact that I take losses. I take a lot of losses, but P&L curves upwards, baby. So I mean, I don't know what to tell you. All right, so that's really the topic I wanted to discuss. Since we're already here on the ES, let's talk about some levels, okay? Like I said, I very well may be looking at certain individual names to start long swing positions on. But you guys have to also understand I'm a day trader as well, and I will 100% be looking for long setups and short setups as day trades, right? So I do have to look at levels just from a trader's perspective. So let's make this let's do an hourly chart and see, is my chart set up right? I feel like things look a little weird here. Let's do a 2 hour and see if it, yeah, I don't know why my moving averages look so, let's see if I can change with this. Maybe it's just the way I have it. Sometimes I do this, right? Like I make things bigger for you guys so you can see it, but let's look at levels. All right, to the downside, I am kind of watching this uptrend or this uptrend line. Let's see if I can zoom out far enough you can see where it came from. Let's go back to a daily real fast. So this uptrend line is just from March 2020 lows up through where we recently put in a low. It kind of lines up real nice with that monthly pivot. And that's kind of what I'm looking for in terms of like the first real level where I would be watching for some support. Below that, and remember guys, what I'm going to do is I'll go and set my alerts after the Sunday prep. I don't want to waste your time by setting alerts right now. So I'll call them out live right now. That monthly pivot / this uptrend line, I do kind of have my eyes on it. This, I don't know what I was doing there. Anyway, below that, I'm looking at these 3720 area, okay? 3720 and then June's lows, okay? And obviously June's lows, if we were to flush really, really fast down into those levels and even break them, the faster we accelerate to the downside, I'm still really, really leaning into long ideas, at least until we have that big bounce to where I can put those shorts on, right? So June's lows is big support for me, 3720 and then 3830. And this is all granted we don't gap down below this 38 level. If we gap up, if we were to gap up somewhere into like the underside of the 20-day, I would probably watch into this 3880 area as support as well. As far as resistance goes, that 4,000 level, it's been nonstop in every Sunday prep, right? Psychological round level, round number, the 20-day, the 50-day, the quarterly pivot, the last month's monthly pivot, and the annual pivot, all stacked, all in that area, right? So 4K, above that, I'm looking at 41, call it 4115. Above that, I'm looking 4160s. And then obviously the 200 days up there with some other levels. But again, I'm more focused with Monday and how Monday's, where Monday's most likely to trade versus, you know, the whole week. Even though I can tell you, you know, like if we rip and keep ripping, there's levels up here where I would be setting on Tuesday and Wednesday and Thursday, right? Like 4480 and 4580, right? So, but again, I don't need to put those alerts in yet. I do a Sunday prep, I do a Monday prep, I do a Tuesday prep, a Wednesday prep. You guys have to do your own preps, right? I try to do these as a way to give you a bit of foundation for the week ahead, but also to show you guys what you should be doing yourselves every single night before you go to bed, so you're ready for the next day. So let's get into the NQ. Remember, everything I just said about the ES is going to be the exact same in terms of the NQ. We have the same trigger, same setup on the weekly. You guys see it right here. Here's your push up, your lower high, and then the break to make the lower low. And so it has a defined target of down here on June's lows. What is the target would be 11,068.5, and below that, and the downtrend continues, and we go back to stalking. And if you wanted to be the person that is anticipating a higher low, then, you know, flushes a little bit lower anywhere where you feel comfortable risking June's lows. So exact same concept. This is just the tech sector, right? The growth stocks here in the NQ. So let's go back to the daily and then intraday. And for levels, in If we gap up, I'm looking at Friday's lows as support. Then below that, I am looking at 11.5, 11.350, and then June's lows. And then for resistance, obviously the 20-day, I would use that as kind of a range. The 20-day in that quarterly pivot, and the 50-day in this downward sloping trend line. Let's just call it 12.6, somewhere in there. And then obviously above that, 12.9. And let's just call 13,200. Those are the areas I'd be watching as resistance. Any kind of emotional moves up into those levels, and I'm probably looking to put on short positions, okay? And then let's quickly glance at some Bitcoin. The crypto world still going sideways. Keep talking about this. It's just in this channel. One thing I wanted to point out is that the weekly 20 is definitely catching up, right? This thing is just creeping on down. It may be one of those scenarios where we just go sideways till the weekly 20 gets there, and then that's what it takes to get us lower. Now, we do have the lower high. It has not triggered below these lows here. I feel like we lose, what is it, 18,527. I'm not so sure that that 17,500 level is going to hold. I feel like that's the trigger to get you there, and then next leg down. And it's crazy to think this, but like, I feel like there's nothing below there till about 12.5. So we'll see what happens. Again, the weekly 20 is not quite there yet, and we are, if you zoom in a little bit right to the daily chart, we are just channeling sideways as we have been for weeks now. But it's not looking so good if we lose September 7th lows. That's my look on Bitcoin, guys. All right, so sector analysis. Like I said, there's some things I wanted to kind of talk about real quick on the sectors. Now, we had that weekly short continuation trigger on the broader markets, right? The ES and Nasdaq, or the S&P and Nasdaq. And you'll see the same triggers happen on SPY and the QQQ as well, guys. So if you guys need to see it on those charts, they're there. But some sectors have yet to have that trigger, and they are set up for them, right? So if you look at a weekly here on the retail, you have the lower high. Obviously, this one's a lot wider and sloppier, right? Because we had that big push up. Whoops. Oh, why did I use that circle? Sorry. You had that big push up, and then we had this lower high set up here. So you'll see I have a lot of alerts set below 2 weeks ago's lows to be notified. Like if I hover over it, you'll see it says short continuation trigger. Why would I want to know that? Well, I want to know when some of these sectors are following through just like the broader market did. But it's also important to note that the fact that some of these sectors didn't trigger that same setup, meanwhile other sectors did, shows a bit of relative strength for those sectors, right? They weren't pulled into that whole downside last week. Now, it's not that they didn't have downside, right? Like if we look at retail, right? It was down, but it held levels, okay? And you'll notice that on some of these sectors. Financials is one of them. And so you'll see I have the alert set there. Now, remember what I've been talking about for the last, I don't know, few weeks, months maybe, about certain sectors behaving more conducive or more productively than others, right? So like communications have just been getting smoked. Like building materials and industrials, like slammed into really key resistance levels and then lost and came right back, right? Like I'll show you real fast, right? Like just slammed up into them and sold right back off, right up into really key resistance and sold right back off. Financials, man, I keep saying this. I just feel like that level is so key, right? And it doesn't mean we're going to hold this level, but if it does hold this level and we are going to, if we're going to anticipate a higher low on the monthly time frame for the ES or the NQ, and we're looking at sectors where we could express those ideas, for me, the two sectors that I'm really looking to do this on are financials and tech. And I told you I was going to do this. I want to show you guys something. If you guys don't know this about TradingView, you can overlay different things onto your chart, right? So here's the Fed fund rate. I'm going to put it on a new pane down here. And you can see that, rising interest rates don't necessarily mean that financials are going to perform poorly, right? In fact, it's when they start cutting the rates, when we go into those recessions and stuff, that the recessions are what kill the financials. Think about it. Like, financials got destroyed. If you look at how much percentage loss to the ETF occurred during 2008, 2009 on all the different sectors, financials gave back, like, I want to say 90% from highs to lows, right? Let's look. 84%, right? Why? Well, because duh, it was the banks that caused the whole problem with the mortgage and the housing crisis. Of course, this sector just got absolutely hammered, right? But I don't know if that's going to happen here. And yes, they're raising rates, right? I think they're going to keep raising rates. If we don't go into a recession, this is the set. And I know there's people, I've been listening to really, really smart people. And it's funny because one of the things I've taught myself over the years is it's okay to listen to really, really smart people talk about stuff that is way above my pay grade, as long as I'm able to still have my own ideas, my own trade ideas and thoughts, and stick to them, regardless of what all these other people are saying. Because a lot of people out there that are really smart about this stuff are like, the financials are like a do not touch sector right now. But I keep looking at it and just saying, technically, it keeps behaving really freaking well. It held that level so many times, had a little failed breakdown into the weekly 200 and just straight reclaim. And what I'm looking for is what I want to happen. And this is going to sound crazy. I want this to have a short continuation trigger. Because if it does, it's going to give me the higher low possibility on the monthly time frame to where I can anticipate. And there's a lot of charts, a lot of single individual names in this sector where I feel like I have good setups and good risk reward, and I'm willing to go ahead and put those trades on, regardless what all the smart people are saying. And I'm okay being wrong, right? Dude, I have no problem telling my friends that are macro fundamental guys, like, dude, you were so right about the financials, man. I took a loss, but it's okay, right? But yeah, like that's, and I actually have a special situation section at the end of the prep this week where we'll talk about some of these ideas. So I'm not going to spend too much more time talking about that right now, but I did want to kind of point out how you can overlay that Fed funds rate, or you can do it with a lot of other things too, right? You could just overlay the ES or the NQ onto any ETF or any other chart and see if there's correlations, right? Like, I wanted to know, like, what do these ETFs do when interest rates are being raised? God, I can't talk right now. Versus when they're cutting rates, right? So, cool little neat feature to TradingView. I'm sure plenty of people already know about it, but again, and so one of the things I want to point out is some of these sectors didn't have that same short continuation trigger, and some did. Like, look, this one fell apart, right? Here's your push it up into the weekly 20, pull back, lower high, and it snapped. It snapped like a mofo last week. That's real estate. This is healthcare, has yet to do it, right? Has yet to make that short continuation trigger. You see I have the alert set. And again, I think that's one of those ones where if it does lose those levels, I think that this is one of those sectors that will finally start to roll over, right? It's held up very well so far, but what we've talked about plenty of times is that bear markets, if it is going to be an extended bear market, all sectors eventually will roll over and get hit, right? If the bear market's about to end, maybe some of these things hold up, like 2015 and late 2018. It wasn't like a bloodbath in every sector, but it's one of those things where you just make if-then statements and let the author play the story, right? We don't get to choose what happens. But I think if we do get that short continuation trigger, one, I think we for sure are going to flush down and test these June lows on this sector. And again, I do think that this is one of those sectors that's yet to really roll over, and it very well may so if that happens. Building materials. Let me go to the weekly. There's another one. Had the trigger, got smoked, right? Lower high, lower low, rolls over. Probably coming down here to test the June lows again. And remember, if they triggered and rolled over really fast, and some sectors didn't, the ones that had these triggers and really rolled over, those are the ones that were showing the relative weakness, right? The higher correlation to doing what the market's doing. I totally forgot to go to bar chart today. You guys want me to pull that up real quick? You guys can see the stock sector matrix. Jeez, come on, guys. Here's the short-term matrix. Again, everything, it was a bloodbath, right? But you can see there's definitely some that had a little bit of relative strength. And the ones that had that strength are the ones that never had that same short continuation trigger. The ones that got smoked definitely had those short continuation triggers, right? Just wanted to show you that real quick. Okay, now utilities. I wanted to point something out about utilities. We talked about, you know, staples and utilities and defensive stocks, and there's certain things that tend to perform better in a bear market and in late stage cycles. But again, when they roll over, the bear market comes for all of them, right? And so what happened last week on utilities? It had this failed breakout. It really, like, that's not what you want to see. Like, if this is going to continue higher, you don't want to see it just break these recent highs and just get smoked, right? So honestly, I feel like under what is this, 74.05, and this utilities may start rolling over too. And you know, again, like I said earlier, poke holes in your ideas, right? That to me is kind of a red flag. If even the sectors that had been holding up, such as utilities and healthcare and staples, if those start rolling over and getting really ugly, then the chances of the bear market being over and that monthly chart putting in that higher low are very low, right? I mean, the probability of that trade working out is already a low probability trade. The only reason it's interesting is the asymmetry, right? The win rate on it's probably low. The risk reward is phenomenal. So you have to understand that. But this is how you poke holes in it, right? If I see utilities start rolling over and healthcare and staples, I'm probably gonna go, yeah, like, let's just, if anything, pump the brakes. If we are putting on these positions that we're going to discuss later, maybe they're even a fraction of what I was planning on risking. You know, the best traders are not always the best at being right all the time, but they are really good at knowing when to avoid trades, right? One of the easiest ways to increase your profitability isn't to win more or to have bigger winners. It's the ability to just completely avoid the trades that were avoidable losses. Definitely something worth knowing and keeping in the back of your head. Here's staples. Remember, guys, this thing, we talk about it all the time, how it's just unable to really reclaim this trend line. And then we got the lower high. It definitely triggered the short continuation trigger. This thing loses June's lows. That would be one of those red flags for me with that anticipation trade, right? To probably avoid that anticipation trade. Granted, I don't know if this rolls over and breaks June's lows prior to me starting to kind of work my way into those positions. But it would be one of those, hey, reassess, you know. In fact, I'm setting some alerts down here. I'm just going to put see, as simple as that, guys. Staples, that was staples. Discretionary, this one, I'm surprised it didn't trigger that short continuation trigger, right? Because if this is going to be a recession in the near future, I mean, technically it is a recession. Remember, the government kind of redefined what a recession is, as silly as that sounds. I mean, all of us civilians out there paying for protein at the grocery store know it when we see it, but whatever. But for this to not have triggered and have a bit of relative strength in that sector, now granted, it still could trigger, right? But I'm surprised it didn't last week. So I do have the alert set for when it does, and if it does, this 148.50 area would be where I would look for bounce plays on that, just because it, you know, remember, I like this sector in terms of day trades because it's got a lot of names that have liquidity and range. So any kind of flushes down to 148.50, even though I think that bodes poorly for the sector overall, I think we get extended down into those levels and you have bounce plays, right? Again, just like we talked about with the S&P and the Nasdaq, you don't want to shorten the hole. You want to be looking for bounce plays when we get extended to the downside as far as day trades. And when you put on those short positions, you want to make sure that we're pushing back in the levels of resistance. You don't want to be getting caught in the rallies, okay? Communications still looks ugly as all sin, just made new lows, right? Like, this is just what relative weakness looks like, guys. Talk about it week after week after week. Bios. Now, Bios, in order for it to have the short continuation trigger, needs to lose this really key level, right? So I don't know if it does or not. I have the alert set there. You can see it says short continuation trigger, but I still have like this weird soft spot in my back of my head about this sector and this finally having this reversal after a really long, big, extended downtrend. So if it can continue to hold and then break out of this downtrend line, I think, you know, it's set up proper for a big move, but we got to stay objective, right? If it breaks these lows and rolls over, it's not the end of the world for the sector, right? Because you still have the monthly time frame here, right? We still could just get this higher low on the monthly, and as long as we don't take out these levels down here under the 62 area, it's still intact. So it's not the end of the world, but I would like to see it hold here. Again, it's not up to me, guys. I wish it was, but it's just all I can do is make plans, right? If then. XLK, now this one had the short continuation trigger, and it's the tech sector, and it's getting extended to the downside, and there's a lot of names that have range and liquidity. So I'm looking for longs into levels, right? Into extensions down, but I'm also, this is one of those sectors where when we get late bear market to early new secular bull market, tech growth performs, right? So do the financials, which is another good reason why I kind of want to be very specific about where I deploy capital when I do try to anticipate a higher low, right? When I try to anticipate the ending of a downtrend and the beginning of the new uptrend. I don't want to just be throwing mud at the wall, so to speak. Now, oil and energy, I do want to make a comment about them, and that is, you know, so far, and we talked about this last week, was when these big uptrends that they've been in end, it's going to be obvious because it's going to be, you know, lower highs, and it's just going to struggle to reclaim areas. We're going to probably lose this trend line. It's been holding so beautifully. There's going to be so many signs that it's reversing from this uptrend we're in that it's going to be very obvious. But the one thing that I really feel that this thing did, that if it was still healthy, it shouldn't have, at least in my opinion, right? And that is, this is the first time it's had this real big speed up, right? Like, it really kind of came to a crescendo there. And it did it in oil too, right? That's energy. And oil had the same thing, right? This really big move. Everything else has been this really controlled uptrend, pullbacks to the weekly 20, right? Like, if you look at this, it's just the most controlled uptrend ever. And until just a few weeks back, right? Actually, a few months ago, when we had that big run up, remember that was with the oil and energy issues going on with the Ukraine-Russia thing. Like, this was an emotional big move up, and it wasn't healthy, and that's why we had that big correction. But what it needs to do is it needs to stay healthy now and get back above those highs, or I think it could actually be in trouble, right? I feel like to reclaim those highs is going to take some time and some sideways action and some digestion, and then to curl and kind of work its way back up there. But there is a distinct possibility that this thing, both oil and energy, take out those recent lows that it had after that big move up and it had that pullback, and that could really start to make these charts look broke. I do want to just keep that in the back of my head, because those aren't scenarios that are playing out this week or next week. These are the kinds of things that will take weeks and months to develop. But that is definitely my thought process on these, is that those moves up were very emotional and not healthy trends, and that's why they gave the big capitulation. And now they're just trying to recenter and refocus and get their bounce back, right? All right, so that's it for the sectors. That's all I want to talk about with the sectors. We're going to get into the ideas. As always, we're going to start with the long ideas, the long setups, strong stocks looking for continuation. And the first stock on the list is Pinterest. I think it was on last week's too. I don't remember. Now, I absolutely hate the fact that it's getting a lot of attention lately with, I think it was Citron, right? And possibly even some others talking about, I believe, acquisition chatter or whatever. I don't like when things get that much attention. Things get crowded, but technically I feel like it's just behaving really well. I'm looking for flushes into 22 to try to kind of get scoops. I don't know if we get them this week. That's really far away, right? We're at 25 right now. You know, that would be a 3-point flush, but it puts us into that monthly pivot and this little uptrend here from, you know, just started back in August and up through into September. I would look for any sort of emotional flush. I don't want to see it just work its way down there. If it does, great. I might look for other setups down there. But I'm talking early in the week, Monday or Tuesday, some sort of emotional flush down into that level. While I remember this, me talking out loud just reminded me. I forgot to tell you guys, big thing is FOMC on Wednesday, right? So make sure you guys understand the economic events coming up for the week. Remember, we talked about that last week, just going to marketwatch.com, and they have the economic policy calendar for the week ahead laid out for you, right? There's also housing numbers this coming week. So, and make sure you understand how that could affect any positions you have on or day trades that you're playing with as well on Wednesday. But again, Monday or Tuesday, any sort of flushes down into 22, if they're emotional, I want to be there for scoops. All right, the next idea is RIVN, and it's been behaving really well. I still think this chart is very much so intact. Granted, here's one thing that you'll see happen. I've been taking note of this. I told you guys, I think a few times on the preps, is in bear markets, you constantly see these new highs. Notice like Thursday, right? New high, slam back down, basically a failed breakout, right? When these happen after these big moves up, you tend to get big retraces. So I'm thinking flushes down into the 20-day. 35 is where I'm trying to get involved on RIVN, the 20-day. You got the 50-day right there as well. But if it gets below there, like again, I always tell you guys this, I don't have a problem being wrong, taking a loss, and revisiting, right? If we come down into the annual pivot and it's lining up with this trend line, I'd also visit that same idea right there. But 34.90, 34.80, somewhere in there is where I'm looking for early in the week. And that's RIVN. The next idea is SBUX. And I know, so a lot of people, we had this big move up mid last week. That was Wednesday, I believe, right? Wednesday. And, a lot of people in the room caught that short. Congrats to them. But I still think this chart is very much intact, right? Like, and again, granted, here's your failed breakout right here, which no one likes to see. But I think that as long as this chart stays intact the way it has been, I think dip buyers are still around. I think that they just didn't want to chase up too high. But I think first level I'm looking is 89 to 90, somewhere in the 89 to 90 area on a flush. I'd be looking for this to give a good bounce. Obviously there's a lot of levels lower where I would think you get a higher probability area to be a buyer. But, we've had 2 days of selling. It hung around both days, putting in those little doji candles. It doesn't seem to want to sell off as much as I think people thought. I think if we get down into this 89.50 area emotionally on Monday, I would love it for a scoop. That's SBUX. Snow is the next idea. 2 spots I'm watching. First is a flush. What did I write down? 180 / the 20-day, which lines up with, what is that, Tuesday's lows? Yeah, so Tuesday's lows / 180, the 20-day. That's where I'd like it at first. If it gets below there, obviously this quarterly pivot lines up real nice with the 50-day. I don't know if it's going to still be lining up with the 50-day, and honestly, I don't care, because moving averages are nice and all, but really these levels that have been tested so many times, right? Like this 165 area, you can just see how it's reacted so many times that I don't care if there's a moving average there or not, right? If I can just draw a straight line across from there and see it lining up with so many levels, that's what's important, right? It's nice when a moving average lines up. It's nice when a Fibonacci level lines up. It's nice when all these other confluence things come together. But key levels on a daily chart and a weekly chart will do you some damn good, guys. Okay? So that's snow, 2 levels, right? 180 and 165. 165, I don't know if we see that. Probably not early in the week. Depending on what FOMC says, maybe we get a crazy panic flush on Wednesday down into those levels. Who knows? And the last name on this list is Wolf. And this one, I just can't ignore the 20-day trend, right? Even before it had the big gap up on earnings, it was trending on that 20 perfectly. Every pullback to the 20-day held. Now we get this big move up. It really, really did respect some levels, right? We had the failed breakout here, and it sold off. Again, something you see a lot of in these bear markets, right? Breakout, bag buyers, sell back off, pull into support, and then just start trending again, right? That's all it's doing. Pull back to the 20-day, trend. So I'm just looking for dips to the 20-day. I'm looking basically versus Friday's lows on this name for a scoop. Make sure. Oh, and actually, no. 116 I actually wrote down would have my eyes, and that was based off these levels. Let's zoom out a little bit here. Just draw a line straight across from 116. You see all these intraday levels? Boom. Boom. Support. Get under it. Get back above it. Support. So any kind of flush down into 116, which is about a 4-point flush from where we closed on Friday, that would be where I look to probably scoop a little bit of wolf. If it gets below there, then we're probably looking 113. All right. So 2 different levels I would have. Now, next section, oversold reversals. FedEx. First thing I want to say about this is I don't, maybe the lows are in based on that Friday candle, but I honestly am not very anxious to get involved in this one at all. Like, I think for me personally, I'd like to see this down into the 140 area where we're filling this gap down here. This gap from, I don't know how long ago that was, June 2020. Yeah. I want to see that gap fill before I get really kind of even thinking about it. And maybe I don't. Maybe Friday put in the lows and I just missed this trade. Obviously, you could watch intraday, watch for this thing to. Let me go back to a 5-minute. You could obviously watch for some sort of like either open flat or gap up a bit and maybe flush into 157 with risk under 155. I just don't want it, right? Like I for whatever reason, there's something about it I don't like the long yet. I'm looking for 140 on the name to get interested. But I'm just keeping it on radar. That's why I throw it out there, guys. Adobe, kind of similar situation, but this one, you had the big gap down, and then you had a second gap down and follow through, and so now that's when I start to get interested, right? I'm more interested in Adobe than FedEx by far. And I even wrote down, as much as I absolutely despise this company for personal reasons, kind of have to keep personal bias at bay and look at it as though there may be an asymmetric trade here if Friday's lows hold. So that's the idea, right? Any kind of weak open and then looking for a trend to form and join trend for an up for a long. Maybe it even gaps up a bit and pulls back, just does like a gap to close right into 300. You got the psychological level there, below Friday's lows, and the trade's off. Simple as that. Oracle. Just waiting for the inevitable day when the sellers run out. Like, look at the volume on this selling, right? This was the big gap up earnings that just got smoked. Really, really ugly candle on that day. And it's just been huge volume after huge volume of selling. So what I'm looking for is that day when there's just no more sellers left, right? And that day, I don't care when it comes, but when it comes, I want to be present and stalking this to see higher lows intraday and join trend, because one of these days, this won't just sell off like this to infinity, and hopefully it doesn't do what we did here, right? Hopefully it's not. Now, granted, this one here, the gap up was because of earnings, right? So I don't think that's going to happen. What I'm hoping, is that we don't just have some sort of huge gap up that takes the trade away. I want just maybe another day of capitulation would be amazing. 65s would be really dope. I don't know if we see it, but remember, wait for the sellers to just dry up, because there's only going to be, at a certain point, anybody that wanted out is going to get out. There's just going to be no one left to get out, and there's going to be, the buying's going to outweigh the selling, and we're going to have a big bounce day. Just got to be patient for it. And MasterCard is on my list this week, which is weird, but it's funny. I was actually talking with my boy Cruz, who's in the chat right now, about if there's a possible way to just play this idea I have with options. So I'm kind of looking into it. I don't know. The trade here is, I mean, honestly, like if you look at this level, it's just a clear level. 307, 309, 305, just straight across. Every time we come off down here, right, it gets these big bounces. And now we're into the weekly 200 as well. And the other thing I noted was when we get these bounces, it's after we have the reversal sort of candle, right? Like here on March 8th, it wasn't a complete reversal candle, but you did have the flush out, and then we closed green on the day, right? Here, flush out, kind of green on the day. This is definitely has a good look in terms of what I'd like to see a reversal candle, right? So I'm looking versus Friday's lows. I want to dip anywhere into 309 would be great. I will be watching it off the open. Maybe it just comes down into 311 and holds, but I'll be watching this. And the idea is to get a good move up on a day trade, but possibly leave something on for a runner, because I think this goes back to the 20-day at least, right? So if you're down here risking under 308 or whatever, if you're risking Friday's lows, this is very asymmetric, especially if you can swing. And that's kind of why I was like asking my friend about the ability to use options on it, because with options I can just put the trade on and kind of set it and forget it, where it's like, look, I have a clear stop and I know where the target's at, and if we, if I took some monthlies in October, I'm buying enough time where if it kind of moseys its way up to the 20-day over the next few days or weeks, I think it'd be a nice trade. But I'll probably still play with the equities as well. We'll see. But MasterCard is the last name on this idea. I just really like this level here. Again, I can be wrong, and that's fine. We break Friday's lows, and you won't find me in this trade. Okay, guys? Now we're going to talk about the short setups. Weak stocks looking for continuation. First name on the list is Square. I'm looking for any pop into any pop up into these 70, 71 areas. 70, 90 is what I like with that. You see where it just rejected on Friday or Thursday. Any kind of big move right off the open. Hopefully open flat to maybe 66, 66.50. I want any sort of move into that level to be a really big, extreme, emotional move. But I'm looking to fade Square on any pop into that level. The next idea is Lucid. And boy, look at this daily candle. Look, Thursday and Friday just like got destroyed. This is, honestly, I don't know if I'm going to be right. But when I look at these daily candles, and you ask me, like, do I think this is going to go higher or lower? This thing, it looks like it's trying to tell me, hey, dummy, I'm going lower, right? So I don't know where we open, but I'm looking to fade this thing for sure. And so the idea is, if we gap down, maybe 1570s, 1550s, probably look to fade any kind of pop back into 16. If we don't gap down, I'm looking, 17, 16, 1690s, maybe in 1680s. There's just a lot of people, I think, over the last 2 days that were buyers up there that are bagged, right? And they're any kind of gap down. That's why I almost like the idea if it gaps down better, because any kind of gap down and everybody stuck up here is panicking, and any kind of pop back up in the levels, they're going to be sellers. So I really like the Lucid idea for a fade, especially with the daily chart looking like that, right? Like those candles are hideous. Next idea is AA. Any hard spike into 46, and I expect it to give back at least a substantial amount of it, a move up into that level. I did write down, make sure you have your alert set below 45.50, and you'll see that there were some levels, right, from Wednesday, Thursday, where it was stuffing there, right? So it got under there, and the push ups just kept stuffing. So 45.50 might be it. So make sure you have your alert set below it, because if it stuffs there, I still want to make sure I get alerted and possibly have a trade. But I'd like to see 46, right? You can just see support, And then now we're finding resistance on pops. Any kind of pop up into 46, I want to fade. That's AA. And the last idea on this part is dash 64 pop for a fade. You just see like support got under it, was resistance for a while, and now we gapped below it, right? That was kind of the thing that gets me is, right, you had that nasty day on Thursday, but then the gap down, and we haven't retested. So we fill that gap. I kind of want to fade any kind of pop into 64 on dash. Overbought reversion setups, nothing of note. Now remember, I told you guys, I've got a special situation section this week, which is possible long anticipation plays for longer term portfolios, right? Like I have a SEP IRA, I have my kids' college accounts I trade. Those are all longer term. I don't mess with that stuff very often, but I am willing to use those accounts to possibly put on trades where, like I said, when you're looking at the ES, right, where we're trying to anticipate a higher low here for the possible reversal and ending of a bear market. Granted, there's so many reasons why this market can continue lower. I don't expect to be right, but if I'm right, I'm going to be right huge in terms of risk reward, right? I'm willing, and like I said, guys, it doesn't matter if you're risking $100 to make 1,000, or if you're risking 10,000 to make 100K, right? You guys, it's relative to your account size and your risk appetite. But when these trades present themselves, there is a time and a place to anticipate, right? So remember what I said. I want financial sector and tech stocks, right? So I have some names. The first, what is it? The first three. Actually, is it just the first three? Yeah, it is. The first three are financial sector. Okay, so let's look at them. First one is JPM. Now, do you guys remember what I said about XLF? I want this short continuation trigger underneath 3250 to trigger. I want that to trigger, because if that triggers, it's going to push us down into some levels where, you know, we've already shown the ability to hold support, and we can possibly begin to have a reversal. So this short continuation trigger anywhere down into the 31 area or whatever on XLF is what I'm hoping happens to get these individual stocks down to the levels I want, right? So JPM, you'll notice, let's see what I write. I want 113 area is where I would be interested. So any kind of move down here into these levels, 113 with risk under the lows, right? What did I say? Oh, I'm sorry, no. On this idea, what I would be willing to risk is under 111.50, right? So I would give it under 111.50, buy this dip, and keep this is actually really tight risk for the kind of potential if this wants to turn and move up, okay? So that is the first idea on this anticipation list. Remember, guys, if I put these trades on, I'm very, very okay with being wrong. I actually feel that way about every trade I always put on, but like I want to reiterate about these ideas, because if you guys watching this decide to somehow think about it in terms of how it fits your criteria, and you decide that you want to make it your trade, you have to understand that you're walking into a low probability setup with a high risk reward. That's what we're doing here, and I'm okay with being wrong. I'll take paper cut after paper cut to have those 8-to-1, 9-to-1, 10-to-1 trades, okay? So the idea on JPM, 113 with risk under 111.50. The next one is Morgan Stanley. I'm looking at 77 area with risk under 72. So this one I am risking the lows, right? So under July's lows. 77 with risk under 72. Next idea, Citigroup. 45.50 area with risk under the lows, with risk under 43. Okay, so those are the financial names I'm looking at. And again, remember, guys, I've got really smart friends I've been listening to, and they're like, dude, hands off on financials. So like, I know that the naysayers are out there, and I know that, dude, for every person I can find that is like telling you hands off on financials, I could probably find other guys that are saying, no, I like the financials here, whatever. You can always find somebody that will agree with you. You'll always find someone that disagrees with you. tune out the noise, guys. Look for the trades that fit your risk appetite and put them on, and let the stock do what the stock's going to do. You're going to be wrong a lot, but as long as you understand the concept of being wrong small and being right big, you'll be okay. I promise you guys. All right, so that was Citigroup, guys. It was 45.50 with risk under 43. Okay. The next two names are the tech names I'm watching, and there'll probably be more names I add to this list as I go through more and more charts and as things start to develop. But over the weekend, these are the ones that kind of had my eye. And that the first one is Etsy. Now, Etsy, I'm not going to give it under the lows. It's already kind of shown the ability to be in this uptrend. So, in my opinion, right, like this should already be working, and I'm looking to buy dips and join trend types scenario. And then if the market does make that higher low, then this should get that boost when the market turns, right? So the idea on Etsy is 93 with risk under 90, okay? So basically I want to see it continue to hold trend. And I like this 93 area. You got the quarterly pivot and the weekly 20. And I do like to look at some of the other higher time frame charts. You know, like that short continuation trigger that would happen under 100 would be what would take us down into the levels where I'm looking to buy it, okay, with risk under 90. So 3 points of risk, a lot of upside, okay, if it works. So remember, it's all about the risk reward being in my favor if I'm going to anticipate. And the next idea is one that was already in the Sunday prep, and that's Pinterest. Remember, I like it for day trades, but I also like this because it's already valid, guys. This already triggered the reversal in terms of what I need to see, right? So here's your low. It was very controlled, just down, down, down. This thing was just beaten down. And then you got the push up, and you got your higher low in July, and it triggered on the break, right? So the pop up here, that was your trigger, and now it's like the trade's valid. So at this point, your job is to buy dips where your risk is defined. You're wrong if we lose lows, right? Under 16, and you're objectively wrong about what the thesis was. The thesis is that this is now in an uptrend, and it has a defined target of the monthly 20, right? So if this is going to go from 20 up to the monthly 20, which is currently at 43, I don't think it's going to happen. I don't think it's going to happen overnight, guys, right? This might take months to play out, right? These are long-term swing longs. So over the next few months, this is going to creep down. But dude, it could easily be at 36 when if this works. It could easily be at 36 when it meets the target, right? And if you're buying where I'm looking to get in, which I'll tell you right now, is I'm looking for, I want a dip to 19. I'm going to be really patient, and I'm hoping for 19s. And the reason I think it's possible is because now we're moving up into the descending 200-day. I think there's going to be a lot of people, like I said, it's getting crowded with the Citron pumps and everybody talking about the possibility of a buyout, whatever. It may give you that big capitulation. And if you're patient, you might get to scoop this down at 19 with risk under 16. And you could still very easily be wrong and lose on this trade. So obviously, the closer to where I'm going to stop, the better, which is why I'm trying to be patient for some 19s. In the meantime, like I said, I will be day trading this, right? You remember, this was a long idea for a scoop at 22, right? I want to buy this at 22, and I'm sitting here telling you, but I also want to buy this at 19. So understand the dichotomy of being a day trader, but also managing long-term portfolios, okay? So those are the ideas. Again, make sure that if you play any idea I ever give you, that you create it from your own criteria and you make it your idea. And I don't want credit. If you ever take a trade that I mentioned on a Sunday prep and it works, don't ever DM me and be like, thank you. It's not me. You did it. You hit the buttons. You had to make it your own trade. The same way if it doesn't work, that's on you too. Because I manage my trades, I stop out when I'm wrong, and I eat my losses like a big boy, all right? And you guys got to do the same thing. So when you win, it's you. When you lose, it's you. Don't be hitting me up high-fiving or complaining. So I am going to check and see if there's any questions. Let me pull up the chat. Roy Parker is asking about quad witching. Yeah, he says, is it a real thing? Yes, it is a real thing. I'm scrolling up real fast. Raul, if you've got I'm sorry, I'm not in the right thing in Slack. Hold on. Let me look at the questions. Would you consider options somewhat capped risk product to trade markets? That's by Davram. Depending on how you trade them, your risk is capped on options in terms of, yes, the most you can lose is the value of the contract, right? But there's still the ability to do what a lot of poor traders do with equities, which is add to a loser. You can still do that with options and blow up an account. People do that. So it's kind of like Cruz is in the chat. He'll tell you too, right? Like, you still have to trade very responsibly with a plan. But yes, and I think like what Cruz would probably agree with me is like the benefit to the options sometimes is just the leverage, right? You're like that MasterCard idea, even to take 500 to 1,000 shares of a $300 stock, as opposed to buying some contracts that control 100 shares each contract at, you're talking hundreds of thousands of dollars to express a trade. I'm talking about capital outlay versus a few $1,000s to control the same amount of underlying. So that's kind of the benefit to the option, is being able to have that leverage. But in a way it does cap your risk, but don't think that means that it's somehow safer and that you can't get hurt trading options, because you can. Okay. Ray God wants to know about Amgen long, AMGN. I can look at the chart. Let me see. Let me go back to the charts. The chart is, it's obviously it kind of like reminds me of what MasterCard looked like a minute ago, right? But these guys, this is a pharmaceutical biotech, right? That had negative news recently, which if I remember, it was both these days here. 2 days. This was the day the news came out, was September 12th, and it had a follow through day the next day. It obviously looks like it's finding some support. If I was going along Amgen, which it's not something I trade a lot of, I did actually trade it on the day it had the news, because Catalyst creates the liquidity in the range that I need. If I was going to trade it now, it would be basically the way I was talking about some of those other ideas, where you're using these recent lows as your defined level to risk against. But I personally, I think you could look at this as a short also on a pop back up to 238. I don't know, but it's not one of those ones I really trade very often or and have a lot of desire to trade. Steve says, off topic, but I'm curious about your watch. My watch. my G-Shock. It's my trusty. I like having a strong, like a tough watch, because I'm at the gym a lot and I use the timer on it. I use the timer on my watch for resting in between sets to make sure I'm not one of those people that sits around playing on my phone at the gym. And I use the timer on my watch when I pull shots on my espresso machine. So I actually love this watch a lot. So thanks. I don't know if there's any other questions. I don't see any in the thread. Let me see. I'm going to scroll down and see if I see any more. Okay, Raul says there's one last question. Which one is it? I'm looking. I'm trying to see if I can find it before Raul posts it. Apple and Amazon for a swing. What are your thoughts? That's gonna give me the option to tell you guys something that I've been thinking about lately, and that is, if we go into a bear market that's further, I feel completely fine calling what we're in now a bear market and a recession. But if it extends further, and I'm talking months, quarters further, and we go much lower, when the dust settles, if you look at 2000, 2001, a lot of the legacy names were not the names that were the big, amazing swing long positions when the dust settled, right? Apple had a revamp back then. There was a lot of like Amazon was a game changer, right? But some of the names like the Ciscos and the IBMs and the things that people thought were great companies that are not going anywhere, but we just went into a huge bear market. So they thought those would be the things to buy and they would rebound the quickest, right? I think if we have much more downside and we get into a tailspin of a downtrend, when the dust settles, part of me actually thinks like there's going to be like a regime change in terms of like who these new market leaders are and what emerges, right? So like it'd be interesting to see. I personally, it's not that I'm like anti-Apple or or Amazon or but I just feel like the Alibabas, like Baba, look how far Baba has just become such a, it was a behemoth, it was a giant, right? And it's trading at $80 now. And do I think Baba's ever going back to 200? I don't know. I honestly don't think so. I think like time goes on and new companies come around. They are always gunning for the big guys. Like if you think Amazon is like unsinkable, suggest you look into the movie The Titanic. If you think that I don't even have the chart shown. I was trying to show you guys charts and it's just me on the screen. Sorry. If you think that like Amazon will never have a competitor there that challenges them or takes market share away from them, you're wrong. Like time is the ultimate leveler, and eventually there's always somebody gunning for you that's gonna have a better product or figure out a new edge or a moat or something that's going to make it so that maybe Amazon won't be obsolete, but they won't be the player they were. Like look at Netflix. Netflix was like a huge disruptor, and it put Blockbuster out of business and had the craziest freaking chart ever, right? Like this was a hell of a ride. But guess what? Like there's other players in the game now, right? There's your Rokus and your Fubos and your Hulus and your Peacocks, and there's just all these different things and Disney Plus and all these different ways to stream. Like Netflix isn't the same company it was when it was that new disruptor, right? So when the bear market ends and we start to have good cause to put swing long positions on in our longer term portfolios, it doesn't mean Apple and Amazon and Microsoft aren't good companies to own. But I think there's going to be new companies that emerge from the ashes that become the market leaders. And I don't know what they are. And but the charts will tell you, right? And reading the chart will be all you need to figure those things out. So when that time comes, we'll start discussing those charts and start picking those stocks and talking about them. But that's kind of like what I think of when I think about Apple and Amazon. Zafar, I already covered the crypto stuff. So like when this post, the recording post, you can just go to that section and watch it. It wasn't very interesting anyway. Crypto's just stuck in a sideways channel at the moment. So let's see. Grandizer is asking about NVIDIA, wants me to look at NVIDIA long. NVIDIA long, I don't care about it till 116. We talked about that, right? We're like this. We've talked about this one plenty of times. If it didn't want to hold these levels here at this 135 area, I don't care about it till 116. Does that mean that it gets to 116 or 115? No, it doesn't mean that. But it means that I don't care about it. It's a broke chart. That is broke as it can get. If it comes down to this level and starts to show support, maybe there'll be a trade, but not for me. And ZZ's asking about Honeywell, if I like it long or short. Don't really like it at all either way. Yeah, I don't trade this name very often. Looks like it's you have defined risk. I don't know how you're looking to play it. That's the thing, guys. When you ask me a question and you say HON, L, or S, meaning long or short, that's not a good question in terms of like, what am I supposed to say? Like, I wouldn't short it here because we're so extended, but I'm not looking along it either. And like, it's much better when you kind of ask for, tell me what your idea is, and then I can look at that idea. Yeah, if you're stuck in NVIDIA from 137.50, Grandizer, you probably didn't. I don't know what happened, man. Did you didn't stop out when you were your plan? Because like, here's the thing. The only question you should ask yourself, if you're asking me to look at a chart because you're stuck in it, the question you should be asking yourself is, what was my plan, and at what point did I break my discipline and deviate from my plan? Because nothing I say can help you in your NVIDIA position. It can't. I can't make NVIDIA go higher. I can't make it come and get you out. I can't do anything. I can look at it objectively and tell you what I see. But what I can do to help you is I can tell you that you need to make plans and stick to them. And, take your losses when you need to take them instead of when you're forced to take them. It's so much better to take a loss because you take it than the stock making you take it, right? Like, those are two different things. And like, that's the problem, is like, I do these Sunday preps, and I know a lot of people get in positions and they get bagged in a stock, and they want somebody to tell them everything's going to be all right. I've been there, done that. Trust me. I've been trading long enough that you wouldn't believe how many positions I've been in where I hit up a friend or a mentor or somebody, and I'm like telling them like, God, dude, I'm so screwed on this trade. And like, in hindsight, the only person that can save you is you. Nobody can help you out of a trade. It doesn't even matter like if I had, $1 billion at my disposal and I'm sitting here trying to buy NVIDIA up to get it back to your cost basis. It's not going to work. Like, the stock's going to do what the stock's going to do. Your job is to manage your risk. And trust me, it's not, I feel bad because I wish I could help you, but I can't, right? But here's the thing, if you're stuck at 137.50 and NVIDIA goes to 115, it's at 132 right now, right? It closed at 132. Yeah, you're down 5.5 points, but at 115, you're down a lot more, right? You have to understand there's like, losses can always become way worse. Don't ever think like, oh God, I'm down so much, it can't get any worse. I might as well sit here and hold it, because it can always get worse. And when you say that, when you say like, oh, I'm already down so big, it can't get worse, usually the stock market says, hold my beer. Okay? I've been there, done that. It sucks. The best thing you can do is learn from it so that moving forward, you don't let it happen again. Again, guys, remember that like the purpose of these Sunday preps is to keep you guys safe by being able to read what the author is writing. And that's typically some form or fashion what the topic is at the beginning of every Sunday prep, right? It's whether it's psychological, mental things that I can teach you to help you deal with situations or make plans or read what the author's writing or whatever it is. It's always got one goal in mind, that's to keep you guys safe, right? And ever since we've been in a bear market, it's been like, it weighs on me. It's one of those tough things to do, to come on every single week and give actionable advice that's going to keep you guys safe, because bear markets are not easy, right? Especially for people that are used to just buying the dip or being long only traders, or maybe you're on the sidelines cash only because you only do long-term stuff and you're just itching to get back in. And I'm just like trying to keep people from getting burned, right? So make sure you guys understand that's where I'm coming from. If you guys don't understand the concept that I try to teach, right, like how to read what the author's writing, reading the trend, how time frames interact, those are the kinds of things you guys need to come over to True Trader and I'll teach you. But like, Sunday prep is for me to help you guys prepare for the week ahead. We can go way more in depth if you guys come over to the room, the community, and see what we're all about. Again, there's a coupon, I believe it's YouTube at all caps, gets you 20% off. There's a few other coupon codes. There's a 5-day $30 trial. Invest in yourselves, guys. Like, I swear, anybody that's in the community would tell you hands down, what we're all about, and that it's more of a mentorship service than it is. We don't do alerts. That's not what it is. It's not an alert service. We're there trying to teach people how to fish. So until next week, if you're not in TrueTrader, I'll see you in TrueTrader on Monday. If you're not in TrueTrader, see you in the markets Monday. Hopefully we're making money together and I'm not the one taking